All right, let's talk about a market showdown that's got everyone talking. We've got a pharmaceutical giant going head-to-head with a tech titan. And you might think you know how this story ends, but trust me, the outcome is not what you'd expect.
So, let's just get right into it. The big question we're tackling today is, well, it's a bit of a head-scratcher. In a world where AI and tech are everything, how on earth is a pharmaceutical company not just competing, but absolutely crushing the king of AI stocks, Nvidia? I mean, think about it. Nvidia's chips are the literal engine driving the entire AI revolution. They're arguably one of the most important companies on the planet right now. So yeah, this reversal, it feels like it defies all logic. But the numbers, well, the numbers don't lie. So let's dig in and see what's really going on.
Okay, so first things first. Let's get into the hard data behind this really surprising market twist.
So get this. If you look at the time since the tech sector peaked back on October 29th, Eli Lilly's stock has shot up 30%. At the same time, Nvidia has dropped 14%. That's a massive 44-point swing in just a matter of weeks. So you gotta ask, what is causing such a dramatic shift? And look, this isn't just some random short-term fluke. If we zoom out and look at the whole year, the story is actually the same. Eli Lilly is up 35% for the year. That's outpacing even the AI giant Nvidia, which is up 28%. The key thing to realize here is that this is a sustained trend.
So all of this leads to a pretty obvious question, right? Just how weird is this? Like, how unusual is this kind of performance gap? Let's actually put a number on it.
Okay, so Jessica Rabe over at DataTrek pointed out something fascinating. She noted that on November 25th, Eli Lilly's 50-day return was beating Nvidia's by more than 2 standard deviations away from the long-term average. Now, I know standard deviations can sound like intimidating math jargon, but stick with me. It's actually a really simple way to measure how rare something is.
Yeah, to put it simply, think of standard deviation as just a yardstick for how weird something is. When you hear something is 2 standard deviations away from the norm, that means it's an event that almost never happens. It's like a once-in-a-blue-moon kind of thing for the market.
So how rare are we talking? Well, an outperformance this extreme has only happened on 1.5% of all trading days since 2010. 1.5%. That's not just a fluke, that is a signal that something much bigger is happening under the surface.
So what is that bigger thing? What's going on here? Well, this story isn't really about just 2 companies. To understand it, we've got to zoom out and look at the bigger picture. And that brings us to a really important concept called sector rotation.
So what is sector rotation? It's basically when big money, when investors start moving their cash out of one part of the economy, say technology, and putting it into a completely different area, like healthcare. And right now, there's a huge reason why they're doing that. You've got Eli Lilly at the absolute forefront with these blockbuster weight loss drugs that are, they're changing medicine and raking in massive, massive revenues. That makes the whole healthcare sector look incredibly attractive. And really, that's the real story here. The whole Eli Lilly versus Nvidia thing, that's the headline. But the actual force driving this is that massive and, as we've established, highly unusual rotation of money out of tech and into healthcare, which is seen as more stable and has these huge new growth stories. Okay, so whenever something this rare happens in the markets, the first question everyone asks is, all right, has this happened before? And if it has, what happened next? So let's take a look at what history has to say.
Well, looking back at the data, in the past, after one of these rare events, Nvidia has usually bounced back and ended up beating Eli Lilly. And the tech sector as a whole tended to outperform healthcare by over 11 percentage points. So you'd think, case closed, right? But history can be a little tricky.
And that's why we need a word of caution here. Because while the averages point to a big tech comeback, the reality is a lot more complicated. Take a look at this number, 44%. What in the world could that mean?
That is Nvidia's actual win rate against Eli Lilly in the 50 days after one of these rare events. So even though the average return for Nvidia is positive, it only actually beat Eli Lilly 44% of the time.
You see the disconnect? History says, on average, Nvidia should come out on top, but the real-world odds of that happening have been less than a coin flip. It's just a perfect reminder of that classic warning: past performance is absolutely no guarantee of future results.
So, where does that leave us? After digging through all this data, what's the real bottom line here? What's the main takeaway from this whole fascinating market drama? The analyst we mentioned earlier, Jessica Rabe, she really puts it perfectly. The point of all this isn't to tell you to buy Nvidia or sell Eli Lilly. Not at all.
The data is really just meant to show how extreme this rotation out of the tech sector has been. It's about observation, not prediction.
So the big takeaway isn't about picking a winner between these two stocks. It's about understanding that there's this powerful and very rare market force at play. It's a significant shift of investment, a rotation of money from tech to healthcare. And that's a trend that you can bet investors are watching very, very closely.
And all of this leaves us with the one big question looking forward. Is this whole thing just a temporary shift, a short-term blip before tech comes roaring back to reclaim its throne? Or are we actually witnessing the start of a whole new chapter for the market, where different kinds of industries are going to start taking the lead? I guess only time will tell.